Okay, good afternoon, everyone. So we are going to solve consolidated balance sheet, and this class is about our third part. So please be careful that what we are going to learn actually. We are going to learn the consolidated balance sheet. We are going to learn the consolidated balance sheet at the date of acquisition. Now we should know what is the equation. What is the equation of the consolidated balance sheet? It is assets equal liabilities plus equity, right? This is the balance sheet equation. And here you should remember that this asset should be parents company's asset plus the subsidiaries company's asset. So the asset should be parents companies plus subsidiary company. And we should have liabilities. The liabilities also same. Parents company's liabilities plus the subsidiary company's liabilities. Then we have equity, and this equity is only for parents company's equity. Okay, this equity is only for the parents company's equity, and if we have any non-controlling interest, we have to establish. Okay, we have to establish NCI. So this is the main points of this chapter. We should record parents and subsidiary companies asset. We should record parents and subsidiary companies liability, then parents companies equity, and if we have any non-controlling interest, we have to establish it. Then we have to eliminate. We have to eliminate which accounts? For example, asset equal liabilities plus equity, right? Assets equal liabilities plus equity. So we know that asset minus liability equal equity. So if we record asset, look at here, we record asset both parents and subsidiary company. We record liability both parents and subsidiary company. So this equity should be eliminated. This equity account. So this equity account. So equity account. Equity of subsidiary company. Equity of subsidiary company should be eliminated. Then we have another elimination. We have another elimination from this equation. Assets minus liability equal net asset. Net assets. So net assets means it is the investment of subsidiary company so this is the investment of subsidiary company. So parents company invest in the subsidiary company. So this should also be eliminated. This account should also be eliminated. Eliminate means it should be closed. So we should close investment in subsidiaries. We should close equity of subsidiaries, and we only keep asset and liability. So asset and liability from parents and subsidiary up to here. And if you close equity of subsidiary, you should have equity of parents company. Equity of parents company, and if we have any NCI, you have to establish the NCI under equity. So this is another concept under elimination. Then we have to calculate difference. We have to calculate difference. So how to calculate the difference? How to calculate the difference if implied value is greater than book value, or if implied value is lower than book value. If this is the case, we have to calculate the difference. Okay, we have to calculate the difference. And as we have a difference should be allocated either assets or of subsidiary company. So this is actually the summary of this chapter. So this is the consolidated balance sheet. We have to prove it. Anyway, we have to prove this. Asset of parents company plus asset of subsidiary company plus liability of parents, liability of subsidiary. And for the equity, only parents equity. And if we have any NCI, we have to add NCI under the equity. And which, as we are going to keep, this is the equation, we have to eliminate equity of S company, we have to eliminate the investment of S company. And we have to calculate difference. We can only calculate difference if we have this. And when we have to establish NCI, we have something to know. If parents company acquire less than 100%. So if parent company acquire less than 100%, then we will have to establish the NCI account. Now, based on this concept, based on this important concept, I am going to solve another 2 questions, because last class, part 2, I solved 2 questions. Now we are in the part 3. So we are going to solve another questions. So let's see the questions. This is the question. So implied value. So this is the title. Implied value exceeds the book value. That means implied value is higher. And the book value is lower. So read the question. Assume that on January 1st, 2023, P company acquired 80%. So it is less than 100%. So it is less than 100%. So we have to establish NCI for how many percentage? For remaining 20%. So this is the things you have to immediately think. So as we acquired less than 100%, okay, so we have to establish We have to establish NCI account. We have to establish NCI account. And how much you paid for acquiring 80%? So you acquire 80% and you paid $148,000. So this is your investment. The money you paid is your investment. So what is the journal entry? The journal entry is here. Investment in subsidiary company debit, and you pay cash credit. And we know that we have to close. We have to close it later on. Later on, we have to close this account. Later on, we have to close this account. So you should know this. Now let's see more information. So balance sheet of both companies. Balance sheet of both companies immediately after the acquisition is given. So this is the asset. You know that the asset normal balance, debit. You should know this information. So although you can see that we don't have any debit and credit column here, but you should know this, that cash is asset normal balance debit, other asset normal balance debit, plant and equipment normal balance debit, land normal balance debit, then investment, we already record debit side, you know that. The liabilities normal balance credit. So this is important to know, although you learn it from your principles of accounting 1, but I repeat again, it is important. So common stock normal balance credit, other additional patent capital normal balance credit, retained earnings normal balance credit. Anyway, we know this is asset and liability, and we should know that we have debit and credit information from this account. Now we have to follow the 3 steps. Last lecture, I talked about 3 steps. 3 steps to calculate the difference. So we are going to use these 3 steps. We are going to use these 3 steps to calculate the difference, whether we have any difference or not. And if we have any difference, I told you that if we have any difference, this difference should be allocated where? Either asset or liability of subsidiaries companies. So we already know that we have NCI. According to this question, we already know that we have NCI, but we don't know what is the difference and how to allocate this difference. So we paid for this company is $148,000. For this company, we paid $148,000 here. Then we acquire only 80%. Now we divide this 80%, then we can calculate the implied value. So what is the meaning of implied value? Implied value means what is the market price of subsidiary. Okay, implied value means what is the market price of subsidiary, and it is $150,000. So the market value of subsidiary companies, okay, market value of subsidiary company is $150,000. Now what is the book value of this company? So book value company, how to calculate the book value? If we add the equity account of subsidiary, we can easily know what is the book value. So book value is going to add these 3 accounts: common stock, contributed capital, other contributed capital, and the return earnings. So if we add this, and we find that it is 160,000. Now, implied value is greater, right? Implied value is greater and book value is lower, so we have a difference. What is the difference here? Difference here is $10,000. Difference is $10,000. So we find a difference, and it is important to know that we have difference or not. So this is the difference. Now as we already have non-controlling interest, already have non-controlling interest, we have to allocate the implied value and book value. Okay, we have to allocate implied value and book value to these two groups. Parents company 80%, parents company 80%, and 20% is the subsidiary company. So here you can see that first we are going to allocate implied value. What is the total account of implied value? Total account is $185,000. This one. So implied value, wait a moment. So I have some calculation mistake, maybe. Wait a moment. So here it should be 185,000. $195,000. This is the book value, and the difference is 25,000. 25,000. Now this 185,000 is the implied value. This is the implied value. 80% goes to parents company, and 20% goes to non-controlling interest. So we established here NCI. In short, it is NCI. Now we are going to allocate the book value, because you buy 80% of market price. That means you buy also 80% of the book value. So this is the book value: $100,000, $20,000, and $40,000. $120,000 and $40,000. This is the book value. Okay, we are going to allocate 80% to parents and 20% to subsidiary. Now we find that there is a difference, and difference is the positive. So sometimes in your question, difference may be negative also. So here difference is the positive. Why? Because implied value is higher. Implied value is higher, and the book value is lower. So as book value is lower, so the difference is positive. And we also allocate the difference. We also allocate the difference 80% to parents company and 20% to subsidiary company. We allocate this difference to parents and subsidiary. Now I told you that here, we are already here. We know that there is a difference. We know that implied value is higher, book value is lower, so we have a difference. So we already calculate difference. We already calculate difference. After calculating difference, we are going to allocate this difference. We are going to allocate this difference to asset or liability. Now, this is important that if you want to allocate difference, you have to make it zero. Do you understand? You have to allocate this difference where? So 25,000 is the difference. This difference you are going to allocate according to this question. According to this question, this difference is going to allocate to the land account. The difference is going to attributable or allocate to the land account with historical cost. So why market value is higher? Try to understand. According to this question, market value is higher, but the book value is lower. Why market value is higher? The question said that it is because the land, previous historical land of subsidiary is $40,000. Historical cost $40,000 for the subsidiary company. So land value increase, so market price increase. So this $25,000 is going to increase the land account. So we have to make it zero difference. So difference is positive. Now if we record minus $25,000, it becomes zero. So difference should be zero now. This is important. First, we are going to calculate the difference. After calculating the difference, we make it 0. Why we make it 0? Because this difference is going to add here with the land. So land before historical cost, $40,000 is the historical cost. Is the historical cost plus we are going to add the difference. Difference $25,000. Do you understand? So we make it difference 0. First we calculate difference. I repeat again. First we calculate difference, then we make it 0. After making 0, we transfer it to the land account. So historical cost of land $40,000 plus we are going to add this difference. Now how to do this? How to do this in the work paper? Because in the exam I will mainly ask you to do this working paper. And my suggestion before doing the working paper, you have to record the journal entry first, because this is the elimination column. We have debit and credit. So if you can do the journal entry first, then it will help you to solve the question very easily and accurately. So to fill this problem part, this is blank. In the exam question, you also have the blank. Okay. So how to fill these blanks? We have to do the journal entry first. So this is my suggestion, do the journal entry first. I told you that from the very beginning today, I told you that we have to close equity of subsidiary account and we have to close investment of subsidiary account. Now we are going to close it. So before we record, you can see that before we record investment in subsidiary debit $148,000, to close it, make it credit. So investment in subsidiary, now we record in the credit side. So when we record this item in the credit side, this account close. This account close. So we already close investment in S account. Then we have to close the equity account. So these are the 3 equity accounts. We have to close it. And I told you that here. I told you that equity normal balance credit, right? These 3 accounts, common stock, other contributed capital, return is normal balance credit. To close it, if you want to close it, just make it debit. So we record this 3 account debit. So we record debit and it is closed. Now we know that non-controlling interest here. First part I told that non-controlling interest should go where? Non-controlling interest should go under the equity. And you know that equity normal balance is credit. So if you record NCI normal balance also credit, right? So we established NCI, you know that. We established NCI $37,000, right? $148,000 for parent company implied value and $37,000 for non-controlling interest. So this $37,000 I am going to write in the credit side. So we write debit items to close it. Then we write some credit item. Now difference, where should you put difference? This is the important column. You may have chance to do mistake because difference sometimes debit, difference sometimes credit. So we follow the rules. By following the rules, we record equity account debit side to close it. We record investment account credit to close it, and we record non-controlling interest in the credit side. Now we have another account remaining. It's called difference. Where should we put difference? In the debit side or credit side? According to this example. According to this example, where should you put it? Debit or credit? Debit side. Why debit side? Yeah, credit side is more. Very good. So the difference is $25,000, right? Difference is $25,000. We have to record it. We have to record it in the debit side. We have to record it in the debit side. Clear? Then I told you that after calculating difference, you have to make it 0, right? After calculating difference, you have to make it 0. Why you have to make it 0? Because it should go to the land, right? And I told you that land will increase. Land will increase. Now this difference you record in the debit side. To make it 0, what should you do? To make it 0, you should record it again in the credit side. Do you understand? Look at this difference. Before you record difference in the debit side, right? And you know that this difference should be 0. We put it in the credit side, difference becomes 0. And this $25,000 is going to add where? To the land. And we know that if land increase, it is debit, right? Land increase in the debit. So this journal, according to the journal, we have how many debits? 1, 2, 3, 4, 5 debit, right? And we have 1, 2, 3 credit. So this debit means this debit column, okay? And this credit means this credit column. Now we are going to put this number to their respective account in their debit side. So these 3 accounts, now we are going to record in the debit side here. We put in the debit side. This account, $25,000, we put in the debit side under the difference. So this is the difference. We put it in the debit side. Then we have another debit, $25,000 land. We have another debit, $25,000 land. I put it here. So this is, I copy and paste from journal entry. And when I paste it, I follow the respective account title. Then how many credit we have? First, we have investment in subsidiary company credit. I put it in the credit side, this one. Then we have another credit, $37,000 non-controlling interest. So this is the $37,000 non-controlling interest I put in the credit side. Then we have another credit. We have another credit called difference. We put in the credit side. This is the difference we put in the credit side. So I put debit items in the debit side, credit items in the credit side, following their respective accounts, right? Following their respective accounts. Now, you should remember this formula. That means when you solve the consolidated balance sheet, you already know the equation. I already told you the equation. So this is the, if I copy and paste, so this is the equation. This is the equation of consolidated balance sheet. So this is the equation of consolidated balance sheet. Now to fulfill this equation, you should know another formula that you learned from your Principles of Accounting 1, debit and debit. If you find all debit, okay? If you find all debit, it is plus. That means you have several accounts and all are debit, so you have to add them. Then you have several accounts, all are credit. All are credit, so you have to add them. So if you find something like this, one is debit and another is credit, then you have to make it minus. So this is the formula we are going to apply also. We are going to apply also to prove that we have asset P plus S, liability P plus S, equity only P, and NCI is the non-controlling interest. Now look at here. You know that I already told you this one before. Before I already told you this. Asset is cash is the debit. Before I already told you this one. Cash is debit. These are the debit. So let me solve this one first. Debit. Now look at the cash account first. So we should know that cash, parent company's cash debit, okay, and subsidiaries company's cash debit. So this two debit is going to add, right? Debit and debit plus. So we don't have any information here. Under elimination, look at here, under elimination, we don't have any entry. So we are going to add only debit and debit. So it is something like P plus S. P plus S debit here. P plus S. Then look at the other asset. These two are the debit. So debit, debit plus. So P plus S. Then plant and equipment, we have two accounts. One is subsidiary, one is parent. So P plus S, debit. Now look at the land. This is debit. This is debit. And this is also debit. This is also debit. So look, three debits we have. We have total three debits. And all are debit here. So as these three all are debit, right? So we are going to add them because debit and debit. If you find all debit, it is plus. So again, it is P plus S. P plus S. Now look at here. Investment, it is debit. Investment is debit. And we have another investment here. We have another investment here, it is credit. Right, it is credit. We have another investment, it is credit. So it is now zero. It is zero. Book value, look at here, debit and credit, right? Book value, debit and credit, zero. Now for the liability, the same concept we are going to apply, liability credit. Then we have two credit, parents company and subsidiary, credit, credit plus. So parents company and subsidiary, credit, credit plus, we are going to put this. So I believe you understand this. Then this is debit, credit, zero. We have only P. We have only P account. That means the parents company's common stock. Then we have parents company's other capital, and we have parents company's retained earnings. And non-controlling interest we put in the credit side. Yes, so we established this equation through here. So this is the consolidated balance sheet. We should have 100% accurate like this. We follow this equation. We follow this equation to prepare the consolidated balance sheet. Okay. So this is case 2B. Let's see another question. So this is another question here. This question said that now implied value, market price is lower. Market price is lower and the book value is higher. So if your question is like that, that means the title of the question will not tell you. Title of the question will not tell you which one is higher and which one is lower. Okay. You have to read the question, do some 3 steps process, and you have to determine whether you have higher book value or lower book value, where you have to allocate them. So it depends on the question. So you have to read the question very carefully. So assume that on January 1st, 2013, P company acquired 80%. Again, if it is less than 100%, think about NCI. NCI is 20%. This is the immediately thinking you should have in your mind. Parents company acquired 80%, we have 20% NCI. And how much parent company invest? Parent company invest $120,000. And this is the journal entry for parents companies. So investment in subsidiary debit and cash credit, and you know that later on we have to close this investment account. Then let's see the 3 steps process. We paid $120,000. We paid $120,000. We acquire 80%. We acquire 80%. So what is the market price of this company? Market price of this company is $150,000. So implied value means market price. Market price is $150,000. But what about the book value? Book value is now $160,000. So now you apply the 3-step process, and we find that book value is higher, right? Book value is higher and market price is lower. So we compare these two. Book value is higher and the market price is lower. So there is a difference, right? And how much difference? Difference is $10,000. Difference is $10,000. Now we have to allocate implied value to parents company and non-controlling interest, book value, parents company, and non-controlling interest. So look, we are going to prepare the CAD schedule. So this is called CAD schedule in short. So computation and allocation of the differences. So we see that implied value is $150,000. Implied value is $150,000. We are going to allocate 80% to parents, 30% to subsidiaries. Then we are going to allocate the book value. So this is the book value, and we allocate them 80% and 20%. Then here you can see that the difference is negative. Previous question, the difference was positive. I go back to the previous question. Previous question, the difference was the positive, right? Now new question, the difference is the negative. The difference is the negative. Now if you want to make it 0, because we know that the difference should become 0. The difference should become 0. Why difference should become 0? Because we are going to allocate this difference to some places. So land, we have historical price. Historical price. We know the historical price of the land. We know this. Now, question said that the difference is going to allocate to the land. Now tell me, or try to understand, this difference is a good news or bad news? The difference is $10,000. It is a good news or bad news? Your market price, subsidiary company's market price $150,000, but subsidiary company's book value is 160. It is a good news or bad news for subsidiary? Of course, bad news, right? Because their market price is lower. So market price is lower means they have $10,000 difference, and the question said that it is because their land price drop. So historical price minus difference. Before we record historical price plus difference, can you remember here? Land. This is the land. Look at the land. Historical price plus difference. Historical price plus difference. Now here we are going to record historical price minus difference. Why minus difference? Because land price decrease. Historical cost is how much according to this question? Historical cost is $40,000 minus difference is $10,000. Yes. Now again, my suggestion is to record the journal entry. To record the journal entry. So first we are going to close investment account. We are going to close this investment account before it is debit. Now we are going to make it credit. Credit. Then we are going to close our subsidiaries equity account. We close it. So these are closed, already closed. And we know that non-controlling interest should go to the credit. Non-controlling interest, $30,000 should go to the credit side. Non-controlling interest credit. Now try to understand, where should you put the difference? Difference should be debit or credit. Again, difference should be credit, right? Why difference should be credit? Because credit side is lower. So we put difference in the credit side. Difference in the credit side. Now I told you that this difference should be closed. This difference should be closed and transferred to the land account. So we recorded credit to close, make it debit. Now you can see that difference closed. Difference account already closed. Difference account already closed. And my suggestion to record difference, because you don't know where should you put it, debit or credit. So you have to close the account first, then make a decision where should you put, debit side or credit side. Okay, so difference is closed now. And why market price is lower? Because land value decrease. So land value decrease $10,000, and you know that land increase debit, land decrease credit. So here we already know that land is decreased. This is the case. Historical price was $40,000. Now land value decreased $10,000. Land decreased credit. We recorded credit. Now debit item will go to the debit side. Credit item will go to the credit side of the worksheet. So first, these three make it debit. These three make it debit. Then we have $10,000 difference credit. We have another $10,000 debit difference. So this is the difference column. We put debit. Then we put it again credit. Then we have $120,000 investment in subsidiary. We put it credit. Then we have $30,000 non-controlling interest credit. We put it in the credit. So this debit and credit we put. Okay. After that, we prepare this consolidated balance sheet. And to prepare this consolidated balance sheet, we have to follow this. We have to follow this. So this is the consolidated balance sheet. This is the consolidated balance sheet. So this is parent company's subsidiary company's asset. This is parent company's subsidiary company's liability. This is parent company's equity. we write non-controlling interest and this is the total amount. Okay, so if that's all for today, I am going to share the documents with you. Okay, thank you very much.